guest on the show today needs no introduction. He's the man who coined the word emerging markets. He oversees $50 billion of global assets. A great writer, a fantastic human being, and a great philosopher. Mark Mobius, Executive Chairman of Templeton's Emerging Market Group. Mark, what a delight to have you on ET Now. Thank you for joining us. Are you a bit surprised with the recent Indian market rally? Indian markets are up about 9% in the month of March.
No, I'm not really surprised because I think, the investors have always been here. You get corrections in every market. As you know, India had a very good run. It outperformed for a long time. So you're going to get situations of underperformance for various reasons, not necessarily because of India, but because of what's happening in other parts of the world. The U.S. was underperforming for so long. Finally, people saw some value, and then they went in, and that tended to make these changes.
Mark, the trade which worked out for the first 1 month of this year was to sell EMs, which is emerging markets, and buy DMs, which is developed markets. Do you think that trade is over now?
I believe yes, because this is very temporary. The reason why I say that is the U.S. growth rate will be maybe 2%, 2.5%. Emerging markets will be average, maybe 6.5%, 7%. In the case of India, 8% plus. When you get that kind of difference, there's no way that the slow-growing economic country will be outperforming the fast-growing economies. So I think India will be back.
At Templeton, going forward, are you looking at increasing your weightage to India at a global level now?
Yes, we are. One of the reasons for that is we are continuing to get money coming into the funds, so we have to continue to invest. In addition, the Indian investors are getting more important, so our India funds are also expanding. Of course, here in India, with the interest rates the way they are, there will be a slower growth, but we are still continuing to see growth.
Can you share some numbers with us? What is the current weightage or allocation to Indian markets, and by the year end, by how much it could go up or go down by?
Currently, the global average is about 10% in India, and it probably will not change that much because other markets are also growing. As we allocate into other markets, of course, the percentages will more or less remain the same, but the total amounts will increase.
On a 3-year period, do you think India could be the best performing emerging market in the region?
It could be, and it couldn't be. I mean, it could be one way or the other. You must remember that no one market is the best performing year after year. It just doesn't happen. We'd be very hard pressed to find any market around the world in the last 20 years that in 2-year period was the best performing consecutively. And even in those 20 years, maybe only 2 or 3 markets were the best performing during that period. So you can't expect India to always be the best performing, which is why we always tell people to be globally diversified.
So which currently is your favorite emerging market?
There are a lot of favorites. we buy stocks. We don't buy countries, you must remember. So we're finding terrific stocks here. We're finding great stocks in China, in Korea, in Brazil, in Russia, in Turkey, South Africa, and so forth. So we're really very, very much focused on individual companies. But I must say that the sectors that are most interesting to us here in India and elsewhere are materials, raw materials, commodities, and consumer stocks.
We'll look at specific sectors with you, Mark, but I read your blog and you've raised some concerns about the Chinese economy. What do you think a slowdown in Chinese economy could do to a market like India?
A slowdown in the Chinese economy would have minimal impact on India, although China is now becoming a big trading partner with India, but India's trade is quite diversified. A slowdown in China means going from 9 or 8% to maybe 6%. That's not going to be a very big rule changer or scene changer, so to speak. So I would say that if the Chinese economy went down to, let's say, 4% growth or 3% growth, then everybody has got problems, not only India, but all of Asia, because now China has become the single largest destination for exports from those countries.
Mark, what do you think the Japanese quake problem could do to global liquidity? Because Japan currently has fueled asset classes in the past, Now Japanese investors could pull money out of US bonds, they could pull money out of assets also.
I don't see the Chinese and the Japanese behaving the same way. The Chinese, of course, have been diversifying away from the US dollar and US treasuries. The Japanese are much more loyal to the US and take a much longer view, so they would tend to stay in US treasuries and US dollar. As regards to the total liquidity, I see it increasing, not decreasing, because the construction challenges that Japan now faces requires lots of additional inputs, lots more money to go into the economy to generate construction, infrastructure, new homes, replacement homes, all the rest of the things that need to be done. So I see probably an increase in liquidity, not a decrease.
Do you think there is a rampant speculation in global commodity prices?
There's rampant speculation everywhere. Derivatives now are $600 trillion, 10 times more than the global GDP. So you've got speculation in every category, whether, of course, the biggest market in the world is the currency market. Speculation abounds in currencies. Interest rates are another big area. Commodities, yes, there is speculation, but there's also real demand and limited supply.